Good evening, everyone, and welcome to the third installment in UD's Hen Talk series. My name is Diane Wixow, and I work in the Office of Development and Alumni Relations as the Associate Director for Young Alumni Programs. I'd like to thank everyone for registering for tonight's event. We are excited to continue building this program. Hen Talks is a webinar series that runs throughout the year and features alumni, faculty, staff, and friends of the university who are sharing their Blue Hen brilliance. Webinars tackle career and professional development topics, life skills, and more. This particular webinar is hosted in collaboration with the UD Young Alumni Network. All Hen Talks are recorded and can be accessed after by visiting the Hen Talks page of UD Connection online. Before we get started, I have a few quick notes to share. If you have any questions that you would like to have answered throughout the presentation, please type them in the questions section. We will get to as many as we can, in addition to the questions that were submitted beforehand. We encourage you to keep the conversation going on social media by using the hashtag HenTalks. Finally, if there are any technical concerns preventing you from viewing the webinar, please call Citrix's helpline at 877-582-7011. Today, we have a wonderful presenter lined up to help take the mystery out of filing taxes, Allison Hauk. Allison is the managing partner of Fogg Casson's Rehoboth, Delaware office. Graduating from the University of Delaware with a Bachelor of Science degree in accounting, Allison has been working in the Delaware area since 1998. She remains involved with the university as a mentor for the UD Executive Scholar Mentor Program, and she is a member of the UD Accounting and MIS Advisory Board. Allison is the recipient of such distinctions as the BPW Young Careerist Award and the NAWBO Bridge Builder Award. She was named as Best Accountant in Sussex County in 2014, 2015, and 2016, and Best Charity Volunteer in 2016 by Coastal Style magazine. In addition, she serves on the Board of Ambassadors for the BB Medical Foundation and the Board of Directors of Children and Families First of Delaware. In 2015, she was appointed by Delaware Governor Jack Markell for a 3-year term as a member of the State Board of Accountancy, currently serving as the secretary. She is also active in many local organizations, such as the Lewis Chamber and Rehoboth Dewey Chamber of Commerce, Delaware Society of CPAs, Treasurer for Tri-Delaware, Treasurer of the Rehoboth Beach Sunshine Rotary Club, and recently served as Delaware's designated member of the AICPA National Council. Even with all of these community engagements and start of tax season, Allison carved some time out of her evening to share her expertise with us. Welcome, and thank you for presenting today, Allison.
Thank you. We're going to start off with a couple polling questions this evening, just so I can get a feel for the audience and be able to maybe specifically address some issues as part of the presentation. So on your screen, you're going to see 4 questions, and Diana is going to go through those and give you the options to fill out. So the first one I'd like to ask is, how do you file your tax return? Do you use a tax preparer? Do you do it yourself with software? Do you do it yourself with no software? Or is this your first time filing? Okay, so it looks like about half of you do it yourself on software, and about 29% this is the first time filing it. Okay, good to know. The second question. What is your marital status? Do you file as single or married? Okay, 88% single. Third question, have you itemized taxes in the past? Wait for it to pop up on the screen. Or have you taken the standard deduction, or are you not sure? Okay. Hopefully by the end of this presentation, you will know whether you'll be taking the itemized or standard deductions. And for the last question, what is your employment status? Are you an employee or an independent contractor that receives a 1099 from the organization that you provide services for? Okay, 98% employee. Okay, great. Then I won't spend a lot of time talking about independent contractors, but I will touch on it. Okay. Just waiting for the presentation to pop back up here. Okay, so some things that we'll cover this evening, the forms and due dates, filing status and dependent definitions, the taxation of employee versus independent contractor. Again, based on the survey results, I will focus on employee. Taxable income sources, adjustments to income, the standard deduction and exemption, itemized deductions, tax credits, tax rates, state tax filings, best practices and methods for obtaining and maintaining tax information, and Q&A. I did receive all the questions that have been sent ahead of time, and I will try to address most of those throughout the presentation. You do have a chat screen where you can input other questions that we'll address at the end. And also, you should have received some handouts, which are the pages from the tax return that we will review throughout the presentation. Okay, so forms and due dates. The 1040 is the individual income tax return, which is due on April 15th or October 15th if you file an extension. The one myth I want to have here is most people think that if they file their extension on April 15th, that means they don't have to file the return or pay the tax until October 15th. That is actually not true. If you expect that you are going to owe taxes because you have not had enough withheld from your paycheck to cover your tax liability, you should still pay those taxes in by April 15th with your extension to avoid extra penalties and interest being charged to you. The W-4 is the employee's withholding allowance certificate. Those are normally given to you the first day that you are employed. And there has been some concern with the new tax rates and the fact that exemptions have gone away as to whether or not the W-4s that you filled out in the past are still accurate. They would not be at this point. The IRS is currently working on revising the W-4, and we are supposed to have updated W-4s by February 15th. And they should, at that point in time, reflect the new tax law and your income in that situation. If you do use a tax professional to prepare your tax returns, your tax professional should be able to run projections for you as well to make sure that you're completing your W-4s properly. The W-9 request for taxpayer identification number and certificate. If you do any freelance work, any independent contractor work, that is the form that you would fill out so that the company would be able to properly issue you a 1099 at year end. There's no taxes withheld on those earnings, so you don't have to worry about any deductions, dependents, etc. But you do have to just fill that out so that they have your accurate Social Security number, EIN, name, and address. The W-2, as you're most familiar with, is the wage and tax statement that you receive at year end. They are required to be mailed to all employees by tomorrow. So if you have not received that yet, you should be receiving it this week. And the 1099 miscellaneous is what is received by the independent contractors to be able to file tax returns. I'm sorry, flipped ahead too fast. A couple other forms that I just noted here. I'm not going to go through each one. You may receive 1099 interest, dividends, or Bs. These are if you have any investment accounts that you earn interest, if you sell any stocks, earn dividends on stocks, mutual funds, those types of things. That is what you will receive to be able to file your taxes. A lot of those don't come out until February, so you may not receive them by the end of February. And oftentimes, some of the investment houses like Morgan Stanley, Charles Schwab, they may send out revisions to those, and that usually happens in the February-March timeframe as well. And then if you own businesses, there would be other filings that I just listed the names of the forms. Okay, filing status and dependent definition. So most of you stated that you were filing as single. I will note that there was a question that had been posed as far as if you were, for instance, a grad student or a student in college, and for the first half of the year, you were a dependent of your parents, but for the second half of the year, you were just living on your own, working, and now supporting yourself. Your filing status is based on your status on the very last day of the year. So if you are on your own on the very last day of the year, then you are single. Your parents don't get to claim you for half of the year and you claim yourself half of the year. You are treated as single the entire year. If you're married and you get divorced on December 31st, you are considered single for the entire year. If you get married on New Year's Eve, you are considered married for the entire year. So your filing status is based upon your status on December 31st. To have someone as a dependent, the dependent needs to be a U.S. citizen and must be a relative or other person who lived in your house during the year. You provide more than 50% of the individual's support. They can't make more than $4,050 a year, except in a case of certain children, and they cannot file a joint return for someone else. The dependent status is also important for a head of household because you can be single, but if you have children or other dependents, you can claim head of household, which gives you a little bit higher of a standard deduction than the single filing status does. Okay. Employee versus independent contractor. 98% of you stated that you were employees, so you do receive a W-2. Some of the differences between being an employee and an independent contractor are that you also usually receive your benefits through your employer. You used to be able to deduct unreimbursed employee business expenses. You can still do that for 2017. However, with the new tax law in 2018, those expenses are going away. So the place where we're going to see the most affected is if you're a sales representative for a large corporation or a small corporation. And currently you do not receive reimbursement for your mileage, your cell phone, your computer, your home office, gifts you may be giving to your clients or prospects and things like that. In the past, those have been deductible as an unreimbursed employee business expense, subject to certain income thresholds, which we will discuss when we talk about itemized deductions, but those are no longer deductible. I have seen some companies start to offer reimbursement plans for their employees that are being affected by this, but if you are in this situation, it is definitely something you may want to talk to your employer about. And then the other difference is as an employee, your withholdings are remitted by your employer, so you're not responsible to make your own tax payments. Whereas if you're a self-employed individual, you need to pay all of your own taxes, your own insurance, your own benefits, and you have estimated payments that are to be made throughout the year to keep you out of a penalty situation from not paying enough tax in throughout the year. If you've printed out your handouts and you look at the form that says 1040-2017, page 1, you can see there the box that says income, and that's lines number 7 through 22. What I stated here is what those sources of income would be, things that you might want to consider as you are gathering your documents for preparing your tax return. For those of you that are married or have been married or may eventually be married and have heard some of this in the news, in the past, alimony has been taxed by the person that receives it and has been deductible by the person that pays it. Beginning for all divorces executed in 2019 and later, this will no longer be the case. If divorces were executed prior to 2018, you can still keep that as a deduction if you pay it and have it as income if you receive it. But you'll see the other types of income that I've listed here map exactly to the lines 7 through 22 of page 1 of the 1040. Next, we have the adjustments to income. Those are the bottom section, lines 23 through 37 of Form 1040. These types of things are the alimony student loan interest. You should be receiving documents each year from your company that you pay the interest to, and they'll tell you how much you have paid throughout the year. If you're self-employed and you make health insurance premiums, those are an adjustment to gross income. Retirement plan contributions if you're self-employed, not if you are covered under an employer-sponsored plan. Educator expenses. If you are a teacher, you've been able to deduct $250 worth of your out-of-pocket expenses for classroom supplies or anything you do relating to that job that's not paid for by the school. That was increased under the new law and will be $500 moving forward. Moving expenses, they are subject to certain rules and certain limits, but if you're moving a certain distance away for the job, for the convenience of the employer, and you're not reimbursed for your moving expenses, you are able to deduct those on your tax return. And then certain IRA contributions and the tuition and fees deduction, which can reduce your income by up to $4,000 a year. So standard deduction and exemption. This is one of the terms that on the survey, some of you weren't sure if you take a standard deduction or if you take an itemized deduction. The standard deduction is used in the case where maybe you don't own a home, so you don't have mortgage interest, you don't have real estate taxes, you don't really donate a lot to charity, maybe you've just graduated from college, you're not making that much money right now. So you would take the standard deduction. For 2017, you can see the standard deduction rates, $6,350 for single, $9,350 for HOH, and $12,700 if you're married filing joint. In 2018, with the new tax law, these amounts are almost double. And the reason for this is part of what they're considering the tax simplification, because what they're trying to do is say that a lot of people don't itemize anyway, let's give them a better benefit. This is going to probably cause a little bit more streamlined tax filing because the Schedule A will go away for certain individuals. So starting in 2018, your standard deductions you can see here go up. Now the difference is you used to also be able to take a personal exemption that was $4,050 per person. That will continue through 2017, but beginning in 2018, that is eliminated. And if you look at page 2 of the 1040, line number 42, that's where those would come down. So that did come off of your income to arrive at taxable income in the past. Your itemized deductions. If you look at the handout called Form 1040 Schedule A, you will see the itemized deductions. And what I've kind of done here is given a little bit of explanation about some of the changes. You'll see in the top, there's medical and dental expenses. Those are subject to a 7.5% of adjusted gross income limit, and you're only able to deduct the amount that is over the 7.5%. In that, it includes surgeries, co-pays, things like that you may have to pay for that are not covered by insurance, but it does not include the premiums you pay for an employer-sponsored plan. The taxes you paid section. That's any state and local taxes you pay during the year. So if you work in Delaware and you have Delaware tax withheld from your paycheck, that would go in that section. It's also your real estate taxes, and certain states have personal property taxes, Maryland, Florida, and some others. In 2018, that box is going to be limited to $10,000. Some individuals in states like New Jersey, New York, California, where real estate taxes are very high and state taxes are very high, this is going to affect them because that whole section in lines 5 through 8, the total in box 9 will be limited to $10,000. Again, possibly throwing some people into taking the standard deduction of $12,000 single, $24,000 married filing joint, as opposed to being itemized deductions. This is also where the interest section comes in, your mortgage interest, your PMI that you pay for mortgages where you haven't had enough of a down payment, and home equity line credit interest. The home equity line deduction, however, is going away beginning in 2018. So if you own a home and you've taken out a home equity, or you're planning to take a home equity line to do a renovation, unfortunately, you will no longer be able to deduct the interest on that. The next section you see is your gifts to charity. Gifts to charity are deductible up to 50% of your adjusted gross income. So if your adjusted gross income, line 38 on your tax return, is $50,000, you couldn't deduct charitable contributions of more than $25,000. That is going up to 60% in 2018. And then the bottom section, lines 21 through 27, job expenses and certain miscellaneous deductions. These are the unreimbursed employee business expenses that I had stated would be going away beginning in 2018. They were still deductible for 2017. Also, safe deposit box fees, tax prep fees. And another big one here, line 23, that's going to affect a lot of people is if you have brokerage accounts with significant money in them, a lot of times you've been paying high investment fees or brokerage fees. Those are no longer going to be deductible either. So as you can see, a lot of people, now that that whole section is going away, the home equity line interest is going away, and taxes are being limited to $10,000, the standard deduction may be the better option as opposed to itemized deductions. Tax credits. There is a child tax credit of $1,000 per qualifying child that is being increased to $2,000 in 2018. That comes right off the amount of tax. So if your tax was supposed to be $10,000, you have 2 children that you qualify for the full credit. In 2017, your tax would come down to $8,000. In 2018, your tax would come down to $6,000. There is a dependent care credit. You have up to $3,000 for 1 child or up to $6,000 total for 2 or more. There is a subject to phase out above certain income limits. And this is also where your education credits come into play. The one thing with education credits that's been asked is who claims them, if you still live at home with your parents, etc. You have to be able to claim yourself in order to claim the education credit on your tax return. Otherwise, if you are a dependent, your parents could be claiming it on their tax return based on the tuition. So your American Opportunity Credit is up to $2,500 annually to be used during the first 4 years of post-secondary education, typically while you're getting your bachelor's degree. And then there's a lifetime learning credit, which is up to $2,000 and can be used for undergraduate, graduate, or professional degree courses. You can't claim the credits and the tuition and fees deduction, which I spoke about earlier, that could be up to $4,000 a year. You get one or the other. There is a link that I put on this slide for the IRS. And if you go into that link or that page on the IRS website, it's actually very, very helpful to help you determine which credit you could be eligible for. And if you use a tax software, most of them do maximize the credit or the tuition and fees deduction and let you know which one is better for you to take. I did have another question that had been given to about an earned income credit. The earned income credit, you cannot be a dependent of someone else. You cannot have investment income of more than $3,450. That would be interest, dividends, capital gains. And your adjusted gross income must be below $15,010 if you have no children, $10,600 if you're married filing joint. And it does go up based on the number of children that you have but the max is $48,340 for single, $53,930 with 3 kids for married filing joint, and you must be between 25 and 65 years old. So there is a chance that you could get earned income credit in the first couple years that you're working, depending on how much you're making, or later on if you are become unemployed or something like that. There is an earned income credit that is a refundable credit on the tax return that could be available. Unfortunately, there are no specific exemptions or credits for nonprofit professionals, which was another question that had been asked. Tax rates in 2017, they range from 10,000 to 39.6. I'm sorry, 10% to 39.6%. In 2018, they go from 10% to 37%. But what you will note is that the difference in tax rates and the rates became much larger. And I'll give you an example. For someone that earns $40,000 a year, right now your federal tax bracket would be 25%. And that 25% applies to everyone who makes between $37,951 and $91,900. With the new tax plan moving forward, your tax rate's going to go down to 22%, which is the rate for everyone who would make between $38,701 and $82,500. However, the difference here will also be the way that the new tax rates have been written. You're only paying tax on the increase in thresholds. So, for example, you would only pay that 22% on the amount that you earn over $38,701. The other portion of your tax would be based on the lower tax brackets and whatever the threshold limits are for those percentages. So it's most people that earn $40,000 a year, as an example, will make out better under the new tax bracket, and most of them will take the standard deduction as opposed to the itemized deduction. So I just wanted to point that out to you. It's not going to necessarily be the case always, but in most cases. And the new tax law and the new tax rates, everything in it is set to sunset in 8 years, which means if Congress doesn't do anything different, 8 years from now, everything will go back to the way that the current tax law is written. Capital gains rates are 0, 15, or 20% based on what your income is, and that is your tax on dividends and capital gains. Social Security and Medicare is 15.3%. If you're an employee, you're paying half of that, and your employer is paying the other half. So that would be the Social Security and Medicare tax that you see taken out of your paycheck. There's a net income, investment income tax, and an additional Medicare tax. The additional Medicare tax doesn't kick in until you earn over $200,000 a year. And many of you have probably heard a lot of talk about the ACA and the health insurance mandates. For the past couple of years, if you didn't have what they considered minimum essential health care coverage, you were charged a penalty for not having that coverage. That penalty goes away beginning in 2019. So at that point in time, you no longer have to have a minimum essential health coverage policy, and it will not affect your tax return. State taxes. In most cases, you file state taxes in the state where you live and where you work. And in some cases, your resident state will allow a credit for taxes paid to the non-resident state, less any refunds you receive. Some states have local taxes also that are required to be paid. So Philadelphia, there's a Philadelphia wage tax, a Wilmington City wage tax. There's various different local taxes in Pennsylvania and New Jersey. Make sure you check with your local tax office to determine what is required. I know that Berkheimer is the taxing agency in Pennsylvania that handles a lot of those local taxes. And I did put a couple links here. I put Delaware rules for residents working in other states and non-residents working in Delaware. So if you're living in Delaware but you work in Pennsylvania, or you live in Pennsylvania but you work in Delaware, this link will help you determine where you need to pay tax, what taxes you need to pay, and which taxes will come as a credit in the other state. And there's the same thing below for Maryland residents working in other states. And I just chose those simply because of University of Delaware surrounding those states. But you can also look on other state websites to find very similar information. Best practices for obtaining or maintaining your income tax records. I would highly recommend keeping your records for 3 years from the date you filed the return, or 2 years from when you paid the tax that was due, whichever is later. And they can be electronic. In this day and age, I can tell you our firm is completely paperless, so everything we store for our clients is in an electronic filing system. That's fine. If you want to save your documents on a jump drive, if you want to save them on your computer, or back them up somewhere on a cloud so that hopefully nothing happens to them, that is fine. It does not have to be kept in paper. For business records, you want to keep all receipts to support the amounts reported. If you're not using a software, I recommend keeping an expandable file folder and just have categories for each expense and just keep your receipts in there. One thing to note, if you do own your own business or you're an independent contractor, is that beginning in 2018, business client and potential client meals and entertainment are no longer deductible. This is going to be huge for a lot of service industries like accountants and attorneys, salespeople who often are taking out business clients or potential clients for meals as a way to try to get some business. I have some software recommendations here. Quicken is good to use for personal finance. I use that actually for my personal finances. It can download items right from your bank accounts, right from your credit card accounts, instead of having to maintain checkbooks for everything and other ledgers. But if you really want to know what your financial situation is like during the year, or have a good place to find records when it comes to tax prep time. If you have a business, QuickBooks is very good to use, very user-friendly, and has industry-specific packages as well. There were quite a few questions about using tax preparation software. E-filing returns usually does result in faster refunds. In past years, I've seen Delaware refunds come in as quickly as a couple of days, sometimes longer. Same thing with the IRS. But e-filing your returns will result in faster refunds than it would if you paper file the returns. And most states, as well as the IRS, also now have a "Where's my refund?" link on them, so you can go onto those sites after your return's been filed and processed and see when it's going to hit your bank account. TurboTax is a very user-friendly online software. There's an online version and there's a desktop version. It has federal and all state returns. There's also, I think H&R Block might have one called TaxCut, and there's a few others that are around. But TurboTax is the one that I'm more familiar with outside of specific packages that we use at the firm. There's also a free e-file if you qualify for a 1040EZ. So really, if you just have a W-2 and don't have much else, you should be able to qualify for that free e-file, and I have the link there. If you do need to file your paper returns, you don't like to do things electronically, you can get all of the forms and the instructions from the IRS website in order to do so. There is an IRS Interactive Tax Assistant, and I have the link here. This is a really good resource to help you determine what your filing status is, what education credits you have available to you, whether or not people that you think might be dependents are actually qualified, and a lot of other topics. So if you have any questions as you're following through your tax returns, you can check out that website, and it will help you to determine whether or not you're eligible for certain credits. Two things I didn't spend a lot of time on that were in your handouts, and then we'll go right to the Q&A. One I gave was the Schedule C. That is the profit and loss from business. So if you are an independent contractor, or you think you might want to someday open your own business and you are just a sole practitioner, sole proprietor, this is the form that you would file, and it would go right to your page 1 of your 1040. But I thought this would be really important because you can see on here lines 8 through 27 help you to be able to classify your expenses. And then the Schedule E that I had attached is where you would report any rental properties that you may or may not, but that you may own. So you would have your rents received, and then also, again, I've categorized the expenses on that form so you can see what you would need to keep track of. So I believe that is what I had put together. If you have some Q&A, go ahead and start putting those in that chat box, and I will take some time now to answer any questions that you may have. So far, I'm not seeing anything on my screen. Diane, do you have anything that's come in to you?
Yes, I'll start from the top. So the first question was, for my first check in 2017, I was mistakenly taken out Louisiana state taxes by my employer. I live in Texas, where there are no state taxes. Do I have to fill out a Louisiana tax return to get this corrected?
Yes, you should. You could try contacting the Louisiana tax authority, but they're probably going to tell you just to file a tax return. You'd be filing a non-resident return, and when you allocate income, it'll ask you for income allocable to Louisiana. You would put 0, you would put the amount of tax you paid to Louisiana, and then it would show up as a refund.
Great. I do my own taxes through TurboTax, but I'm not sure if and how I should file a mileage reimbursement through my work or research.
So if you are reimbursed mileage, you don't have to report that. That's not a taxable benefit to you. As long as it's been an accountable plan where you have submitted expenses, you've submitted your mileage to your employer or whoever you work for, and they are paying you back. As long as you're an employee, that is not taxable to you. If you are trying to deduct expenses from mileage that you were not reimbursed for and you are an employee, that would be under the itemized deductions. If you qualify to itemize, meaning you have more than the standard deduction, and it is subject to 2% of adjusted gross income. That was at the bottom of the Schedule A, and there's actually a form called a Form 2106 that would get filled out to calculate what the deduction should be.
Could you talk a little bit more about the student loan interest deduction?
The student loan interest deduction, student loan interest should be reported. It's deducted by whoever is paying the student loan. I have had some parents that even though they're paying the student loan, they have allowed the child to take the deduction. But let me just get something. So the debt must be incurred solely to pay for the qualified school expenses. If you use those loans for any other purpose, they would not qualify. Interest is deductible only if the taxpayer has a legal obligation to make interest payments under terms of the loan. The maximum deduction is up to $2,500 of interest, including early payments not yet required, interest on refinanced and consolidated loans, and capitalized interest. And it does phase out at a modified adjusted gross income of $65,000 to $85,000 if you're single, and $135,000 to $165,000 if you're married filing joint. And there is no there's no limit. It is deductible during the period of the loan being paid.
I worked in Delaware for 4 months and then moved to Tennessee with no state tax. I will have 2 W-2s. How is that going to change the way I file my taxes?
It won't change your federal tax return. It will just change your state returns. So what will happen is if you lived in Delaware part of the year and Tennessee part of the year, you will have 2 part-year resident tax returns to file, and you will allocate the income between the 2. If you're using a tax software, chances are you can code those so that, for instance, the W-2 in Delaware only gets taxed in Delaware. The W-2 for Tennessee only gets taxed in Tennessee.
Regarding the property tax changes, I have a primary home and an investment property which is rented out 100% of the time. The property tax on my primary home and the investment property are each under $10,000, but the combination of the 2 properties is over $10,000. Can I still take the full amount, which is over $10,000, or will I be limited to $10,000 for the combined amount?
If your investment property is a rental property, you are taking that interest deduction on Schedule E, which is the rental schedule of rental income. So that you would be able to deduct both because you're only deducting your primary on the Schedule A and your rental property would be on Schedule E. Now, if you have an investment property that is not a rental, so let's say you own a house in Wilmington and you own a beach house in Dewey that you come to on the weekends, and the combined interest between those 2 is over $10,000, you would not be able to deduct all of it, you would only be able to deduct the real estate tax, I'm sorry, not interest, the real estate taxes of $10,000.
You touched on this and said it, but just to reiterate, for every statement that begins with for 2018, can you confirm that these changes do not affect the filings due this April 15th? Rather, they are for the taxes that we'll be doing next year in 2019 for 2018.
Correct. And those references are for the tax year, not for the year that you're actually filing in, since you're always filing in a year past your tax year. So that is correct.
What are the brackets for capital gains taxes? Do holding periods of securities affect the rate?
Yes, I do have those. Let me find them. All right, I'm just making sure I pull up the most recent chart here. Okay, for capital gains, okay, so for long-term capital gains, if you're subject to the top tax rate of 39%, your capital gains rate would be 20%, and that's if the asset is held more than 1 year. If your current tax rate is 25% to 39.6%, your capital gains rate is 15% if held more than 1 year. And your long-term capital gains rate for if you are subject to a regular tax rate of 10% or 15%, then your capital gains tax rate is actually 0%. The short-term capital gain is 39.6% for 1 year or less of an asset held.
Next question. I tried filing with both TurboTax and Credit Karma's tax program last year, and they came up with different numbers, both of which had me owing a lot of money, and I never understood why. To start, why would different websites give different final numbers? I'm guessing I must have messed up somehow.
That could be the case. Sometimes the way that the different tax packages ask the questions as far as getting you to enter information into their software may cause you to accidentally input something incorrectly, because they shouldn't have different tax brackets. They shouldn't have different tax rates. The calculation should not be anything different. So chances are it's based on the way that they asked a question and how you may have answered it, or a number you may have entered that caused a different calculation. As far as owing a lot of money, it could possibly have been that for part of the year you were a dependent of someone else, and then you became claimed yourself, or maybe you changed jobs and the W-4 wasn't completed properly, and there may just not have been enough withheld throughout the year. I often see this happen with individuals that have more than one job, because what happens is when you have a paycheck, that paycheck kind of seems like it's being calculated based on if you made that same amount the entire year. So if you have more than one job, or you're married and your spouse and you have income coming together, it may put you in a higher tax bracket than what you are having your tax withheld on. The other thing is you will see is if you receive bonuses in the future, sometimes your bonuses, you'll be like, holy crap, it looks like 50% of my bonus was taken out. And it's for that same reason. If you have a bonus of $10,000, the payroll software automatically thinks that you're getting paid $10,000 every time you get paid, which is why many times there'll be a higher amount of tax taken out of that bonus.
How do taxes work in terms of stock investments using apps like Robinhood? And what if you have not accounted stock investments on previous tax returns? Are there any penalties?
So I'm not familiar with Robinhood and how that works. I'd have to research that and maybe get the answer back to Diane on this. But the only time you record anything on your tax return is when you sell the investment. So if you have not recorded sales in the past and those have been reported to the IRS, chances are you'll get a notice from them. Their notices right now sometimes are 2 to 3 years behind. I'm seeing notices come in on returns from a couple years ago. But basically, let's say you sold $10,000 of Walt Disney World stock in 2017 and you forgot to put it on your tax return, but the Walt Disney Corporation had reported that sale to the IRS. They could come back to you and give you a notice. The other thing you can do is if you have realized that you have missed recording something in the past, you can amend a tax return, which I highly recommend, because then you're saying to the IRS, look, I realized I made this mistake and now I'm correcting it, rather than them finding it later. And if your question relates to needing to keep track of basis, I would just somehow keep copies of the cost that you buy the stock for, so that later on, if you sell it and whatever app you're using doesn't maintain the cost basis, you know what that was.
What is the best resource to find out about the tax brackets for 2018?
They should be on the IRS website. I know we have them on a handout that we've given to our clients, but if you go to irs.gov and you search for tax brackets, they should have them on there. I'm checking it now, but you should be able to find them on their website.
Okay.
Yes, there.
Oh.
Go ahead.
I was going to move to the next question, but
that's fine. Go ahead.
What are education credits?
So the education credits are the lifetime learning credit and the American Opportunity Credit. Those are based on the amount of tuition that you pay. And there's other factors regarding whether or not you're in an undergrad program or a graduate program, whether you're a full-time student or not. And that is what those are for. I think if you look at one of the slides I had, the one that I have up here right now, the IRS Interactive Tax Assistant, if you go there, that'll help explain the different education credits that are available. But these are all related to tuition being paid in the year that it's being paid. Now, if you do have tuition, but you are reimbursed through a scholarship or a grant or something like that, you cannot include that amount of tuition as calculating the credit or the tuition and fees deduction, because you've been reimbursed for that.
Great. I recently refinanced my student loans from 2 previous student loan providers. Would I submit my 1098 from my new provider that is managing the refinanced loan, or all 3 providers?
If you receive a 1090, chances are if you refinance during the year, you're going to receive a 1098 from all 3 providers, and you would add them all together because it does represent all of the interest that you did pay during 2017.
If I take out a personal loan to pay for school, is that interest deductible?
No.
Okay. When I filed my full-time job through TurboTax, all seemed to work out properly, giving me a small tax return. But when I added my per diem jobs, W-2, additional side work, still through a company, I ended up owing hundreds. Do you know why this is the case?
Yeah, as I stated a couple minutes ago, that was probably because your tax, especially if you have a very small per diem job, you probably have a very small amount of tax being taken out of that check. For instance, let's say you work at a gym and you teach group fitness and are a personal trainer part-time. You may have one check where you're getting paid $100. You may have another where you're getting paid $1,000. It flip-flops. But when you add all of that income to your full-time job, it probably pushed you up into the next tax bracket. And that's not what each individual employer would have been withholding based upon.
Great. I refinanced my student loans this year. Will I have to report that somewhere on my return? I refinanced with a new lender.
No, there's nothing to report with a refinance of that. The only time you have to report any loan refinancing is if you refinance a mortgage. Oftentimes you've paid points that are deductible, or there may be other fees that you paid at the refinance at that time. But from a student loan interest standpoint, there's nothing deductible other than the actual student loan interest paid.
Great. I am single, sending money to my parents who live abroad, not U.S. citizens. I live and work in the U.S. as a permanent resident. Can I claim them as dependents, or can I file as head of household?
They're not living with you, so you would not be able to claim them.
If I were to hire an accountant to help with my taxes, how much time would they typically need to be able to file the taxes prior to the deadline?
Most accounting firms try to cut off they like to have the information no later than April 1st for an April 15th filing. Now, they're all different. Obviously, the sooner you can get everything together, the better. If you have, most of your forms should be to you within the next week or two. So I would recommend hiring an accountant as soon as possible so that you're at least on their list. But I know our rule at our firm is if it's in by April 1st, we guarantee that it will be out on time, provided you've given us all the information.
Great. I live in Connecticut. I do not own a home or have a mortgage, and I am filing as single. Would there be any benefit to doing an itemized return?
You probably would not have anything to itemize. You don't really have anything to itemize other than the state taxes that were withheld from your paycheck. So chances are your itemized deduction is going to be higher. If you're using a software, it will be calculating that for you anyway.
Great. Just give me 1 second to scroll to the next question.
Sure.
I was driving for Uber in the fall of 2017. Can I deduct gas from my driving?
Yes. If you were driving for Uber, you're going to receive a 1099. So you're going to need to file the Schedule C as part of your tax return, which I did give an example of. And there is a section of that schedule on the second page, part 4, called Information on Your Vehicle. And that's where you would put your total business mileage, which would be your Uber miles, and then other miles, and you would get the deduction for just your Uber miles against the income that you earned.
What are the implications of not having health insurance on your taxes?
So there is a penalty charged for 2017 and 2018. It will no longer be charged as of 2018. And I can tell you what that amount is. It's based on a percentage of income, and it is for it's $695 for 2017 and 2018. But I believe there's also a calculation that can be done based on income, so it may be higher or lower. I could find that information out and follow up with Diane on that.
I know money kept within a Roth IRA is not taxed, but does it need to be reported?
No.
Okay.
Let me backtrack. The only time you would need to report that is if you converted a traditional IRA to a Roth IRA during the year.
Great. My stock portfolio is managed through E-Trade, and I'm required to pay taxes on my Am I required to pay taxes on my dividend payments if I haven't transferred money to my checking account? And by money, I'm referring to the dividend payment.
Yes, and E-Trade should issue you a 1099 div for that, but if they don't, you do pay the dividend tax on reinvested dividends, which is essentially what you've done in that situation.
And the question came up with regards to the slides that we have for the presentation. Those slides, along with the recording, will be shared with all of those who are able to attend the webinar. Those were all of the questions that were submitted. If there's any other final questions, to submit them through the questions toolbar, and we can read them aloud. And if not, we can get ready to conclude today's edition of Hen Talks. So thank you again to everyone for attending the webinar and for your questions. I'd like to extend a special thank you to Allison for presenting this evening and for even pulling out resources with some questions that came in after the fact. So thank you for being prepared and just on point this evening. This webinar was hosted in collaboration with the UD Young Alumni Network, where grads of the last decade navigate life after UD. For more on this and other initiatives for young professionals, you can visit udconnection.com/YA. As a reminder, all Hen Talks are recorded and can be accessed by visiting the Hen Talks page of UD Connection. We are always looking for ways to improve our programming, so if you have any suggestions or ideas for future topics, please contact my colleague Zach Corbin, who manages the Hen Talk series and other virtual engagement programs. You can email him directly at zcorbin, ZCORBIN, @udel.edu. I hope everyone was able to take something away from tonight's webinar. Thank you and have a great evening.